The United Arab Emirates, a founding member of OPEC, just told the world they are withdrawing from the oil cartel. A few days before that announcement, they issued a public warning directly to the United States. To understand the weight of that warning, you have to look at their balance sheet. Collectively, the Gulf Cooperation Council holds over $2 trillion in U.S. financial assets. The UAE gave Washington a choice. Because of ongoing regional conflicts disrupting their oil trade, they are running out of cash. They demanded U.S. dollars, or they would sell off a massive chunk of those $2 trillion in assets, a move that would instantly crash American markets. If the U.S. refused, the UAE warned they might price oil exports in Chinese yuan instead. Faced with a devastating market collapse, the United States Treasury Department surrendered. They agreed to give the UAE exactly what they wanted, to prevent a disorderly fire sale of American assets. The Treasury offered them dollar swap lines. In plain terms, a swap line is an emergency loan where the U.S. government hands over cheap, direct cash to foreign central banks to keep them pacified. Washington is no longer dictating the rules of global finance. It is actively paying a multi-billion-dollar ransom to its own allies just to keep the domestic economy afloat. This vulnerability dates back 50 years. In 1971, the U.S. dollar was taken off the gold standard, making it a currency backed by nothing but trust. To fix that, Secretary of State Henry Kissinger struck a secret deal with Saudi Arabia in 1974. Saudi Arabia agreed to price all of its exported oil exclusively in U.S. dollars. Since every country on Earth requires fuel, this created a permanent, mandatory global demand for the dollar. Foreign nations had to acquire American currency to buy oil, and they did that by purchasing U.S. Treasury debt. This arrangement allowed the U.S. government to borrow trillions of dollars cheaply for half a century. But in June 2024, that 50-year security agreement quietly expired. At the exact same time the dollar lost its structural anchor, the current conflict with Iran effectively closed the Strait of Hormuz. This oceanic choke point handles about 20% of the world's entire daily oil and gas supply. Ships from Saudi Arabia, Kuwait, and the UAE all rely on that single strait to get their energy to market. Because the physical flow of oil has stopped, the economies of these major oil states are rapidly shrinking. This photograph of an OPEC meeting illustrates the severe crisis facing Saudi Arabia right now. To cover domestic spending, they need oil at $170 a barrel, but the paper price is intentionally suppressed well below that. Bleeding money and draining reserves, they must find cash immediately by liquidating their accumulated American assets. The blockade of a single physical waterway has trapped the Gulf states. To survive, their only viable option is to threaten the stability of the U.S. financial system to extract the liquidity they need. So if a blockade is causing this crisis, why doesn't the United States use its naval dominance to force the strait open? The answer is entirely financial. The U.S. bond market has become the ultimate check on American military intervention. This graph tracks the interest rate on 10-year U.S. Treasury bonds. When investors get nervous, they demand a higher yield to hold that debt. There is a rigid 4.4% ceiling. Above that, the system breaks down. Every time Washington threatens a military strike, the yield spikes toward 4.4%. They quickly retract the threat, because the U.S. literally cannot afford a broader war. And even if they could afford it, there is a severe physical deficit. China currently controls roughly 60% of global rare earth mining and an even larger share of the processing. The U.S. military has spent the last several months heavily depleting its stockpile of precision missile interceptors. To replace those weapons, defense contractors need tungsten and rare earth minerals, materials entirely controlled by their primary geopolitical rival. For 5 decades, Washington assumed that printing money and engineering financial markets was an adequate substitute for maintaining a physical industrial base. You cannot fight a physical war with paper assets. The rest of the world has noticed this vulnerability. In 2022, the U.S. froze $30 billion of Russia's foreign exchange reserves. Other nations immediately realized that if they hold their national savings in U.S. dollars, those funds can be weaponized against them at any moment. Global central banks, the most conservative financial institutions on Earth, are dumping U.S. Treasuries and buying physical gold at the fastest pace in 50 years. Simultaneously, a complete alternative to the Western financial system has been built. Yuan clearing banks are now fully operational in London, Dubai, and Switzerland, actively securing major global commodity deals. Despite this massive geopolitical realignment, domestic investors remain completely complacent. This chart tracks a modified version of the Warren Buffett Indicator. It takes the total value of the stock market, divided by GDP, adjusted to subtract the massive influx of federal debt. Over the last 70 years, this metric has only crossed the 100% overvaluation threshold 3 times. The first was the peak of the dot-com bubble in 2000. The second was the 2021 bubble, and the third is right now. The stock market is pricing in an endless AI productivity boom and perfect geopolitical peace. Meanwhile, the physical economy is completely stalling out. With the Strait of Hormuz closed, a third of the world's fertilizer trade is trapped, threatening a severe global spike in food inflation. The era of paper fiat hegemony is actively fracturing, making way for a system backed by physical assets and leverage. Any portfolio assuming the old rules still apply is sitting directly in the trap.